In this video, I want to talk about a long-term gold trade. You see we have 12 automated trading systems for gold. These are all short-term strategies, but what if you want to put on a long-term position in gold? How could you do that and limit and know your risk in the futures and futures options markets? First of all, let's take a look at a long-term chart of gold. We're going to use the gold futures contracts. It's currently on December. We're going to go to weekly because we're looking at a long-term price projection. And so gold is currently right around 1906. And so I actually saw this trade yesterday on CNBC. Blue Line Futures, I believe, presented a trade that looks like a good trade. I want to take a look at this with futures and with options, and they are suggesting the micros, trading the micros on this analysis. So here is the trade that I saw. Buy two contracts at 1900. This was yesterday. It's traded below 1900. Buy two more if it goes down to 1855. Your average entry price is 1877.50. Stop loss at 1780. Your target is at 2300 by Q1. So your risk on 4 micros, if the market does actually trade down to 1855 and you get filled on those next two, your risk would be $3,900 on 4 micro gold contracts. If you're stopped out at 1780, you would lose $3,900 plus any slippage in commission. And if those micros do rally to 2,300, you would be up 16,900. So pretty good reward to risk ratio. One of the issues here is you will have to roll your contracts. It's currently December, but if you're talking about Q1, that goes through March. So also, if the market drops below 1780 and then rebounds, you'll be stopped out. It's possible the market could come in here. It could take out the 1780 level. So if the market comes out here, takes out 1780, and then rallies to 2300, you're stopped out in the trade. You assumed you got the risk, and you didn't get the reward, even though your projection was right. Is there a different way to take this long-term trade to reduce your risk, increase your staying power? And then look at some options trades in gold, and I want to show those to you. So here is the option spreadsheet. We're looking at a 2100 call, going along a 2100 call and selling a 2300 put, and we'll talk about actually selling a 2300 call. So you're going along the April 21st 2100 call, selling the April 2300 call to receive some credit. Your cost on that is the ask is $24.90 and the bid is $23.70. So let's do an analysis of this trade from an option perspective. In Interactive Brokers, you can right click here and you can go down to Analytical Tools, Performance Profile, and see how the P&L will perform on this option spread as price changes. So the horizontal axis is price and the vertical axis is P&L. You're looking at the total P&L, and it looks like this option would expire March the 25th, 2021. So it would fall short 6 days. You'd have to hit this price 6 days before the end of Q1. Also, if the option price did not exceed if the price of gold did not exceed 2,100, the option would not be profitable. Actually, would not be profitable. 2,100 plus 22 points. So you'd have to get to 21, 20, wherever your price is, whatever price you get this in. So if you get 21, 25, you're at break even on the trade. So that is the option analysis for this. So you could take this option trade, and if the market dropped below 1780, you would still be in this trade. If the futures traded from 1900 up to 2100, your futures position would be profitable, but your options position would not be profitable. So that's some of the differences and benefits in these trades. Your risk profile is better. If you're absolutely projecting 2300, your return over risk is 7 instead of 4.33, and so you're basically risking 2,500 if you went long here at the ask. You risk 2,500 but plus commission, and your potential max return is 17,508 if it hits that 2,300 level. If it expires if at the end of by March 25th, 2021, if the option is below let's see 21.25 right here, you're right at break even. So 21.25. Your break even. So you'd have to go at 21.25 to be profitable or to be break even. Whereas if you were trading those on gold, you'd be up from, if you have average price of 1877 to 21.26, you would have about 150 points of profit. So that's the difference between futures and options. Wanted to share that with you, show you this tool in Interactive Brokers, show you how you can put on a long-term trade in gold either with futures or with options.